Hey, it's Lisa Last here, and today I want to talk about the difference between a monoline lender and a bank. So, a monoline lender is a lender who only lends on mortgages, as in mono. A bank lends on all kinds of things. They do RSP loans, they open bank accounts, they do home equity lines, they do commercial financing, they do Visa cards. They do the full gamut of products, whereas, like I said, a monoline lender only does mortgages. So in my 15 years of doing mortgages, I would say about 80% of my business goes to a monoline lender versus a bank. And now that's not because I don't love banks. They do a lot of business with me. It's because monoline lenders have a few key features that I think are really fantastic. One of the key features that they have is great customer service with me post-closing. So if you have questions about your mortgage, I love the concept of me sitting on hold so you don't have to. With a monoline lender, they simply sign a form and off we go. I can talk to the lender on your behalf. Most major banks, once the mortgage funds, you're on your own with speaking to them, which I think is a bit of a disappointment, because why sit on hold when I can do that all for you, right? So that's one big reason. Another big reason is penalties. So major banks will typically charge the greater of interest rate differential or a 3-month interest penalty should you leave that lender in the future because you sell, you refinance, you break your back, who knows what happens. When you're working with a monoline lender, what they try to do whenever possible is calculate your interest rate differential rate based on best rate to best rate. Banks tend to do it from best rate to posted rate. So in certain situations when we have a declining rate environment, so right now we're sitting at 5, you get a mortgage, 2 years you're at 3, you want to break the mortgage and move, you may be subject to a larger penalty with a bank than you would with a monoline lender based on how they do their calculations. The other thing is monoline lenders are nothing you need to be afraid of. Monoline lenders have tons of money under administration. Lenders like Merrick's and CMLS. CMLS currently has $45 billion in assets under administration. So you never need to worry about these guys being like small or going out of business and you end up without a mortgage, although that would be super, super sweet. So those are the main differences between the monolines versus the banks. Some banks have bricks and mortar. Monoline lenders are all virtual, so they're never going to say to you, hey, go into the branch. Hey, go into the branch. There is no branch. So they're going to say, hey, talk to your broker, or they're going to talk to you directly. So that's how we choose, a monoline versus a bank. Some situations, banks make a ton of sense. Some situations, monolines make a ton of sense. And sometimes it's really just about the rate or the product that particular lender has.